I have a very important message I need to give to all retail investors out there in the market right now. And going into 2023, I feel like this is the most needed thing out there. And I feel like this video is the most needed thing out there right now, nonetheless. Okay, and I actually wanted to record this video outside. It's raining here today in Vegas. It is a gloomy, cold, rainy day here in Vegas, but unfortunately it was raining a little too much and the computer was getting wet. But nonetheless, I feel like the weather out there today is very appropriate for how I think retail investors are feeling out there in the market, and we've got to talk about that. And so I feel like this is the most needed video I could possibly put out in this sort of market environment. So hope you guys enjoy it. Thank you so much, everybody that subscribed to the channel, and let's just jump straight into it. So to understand the retail investor, right, which the retail investor is me. It's you. We're the retail investors, okay? We don't work on Wall Street. We don't come from that traditional investment banking, like background and all those sorts of things, right? We're retail investors. We do our own research. We pick our own stocks. We make our own investment decisions and those sorts of things. And we don't use like financial advisors. We just do everything ourselves, right? And we're the retail investor. And if you go back to the 1980s and before, the retail investor was fairly non-existent. And there was a lot of reasons why the retail investor was fairly non-existent back then. But the main reason was information. It was very difficult to get information, in the 1980s and prior, essentially, right? This is before the internet age. And so if you were a retail investor, put yourself back in those shoes of somebody back in those days, right? You would have had to actually send like a physical check to, somewhere in New York City, wherever your money was being deposited. Then you'd have to wait for that money to clear, which who knows, by the time it mails all the way over there and gets cleared and everything, it could be 5 or 10 trading days by that point in time, right? Then your money's finally cleared. You have to call, confirm it's actually cleared, right? Then you have to call and say, I want to buy ... stock, right? And you couldn't just like pull up an investor report. You couldn't just listen to a conference call on your phone or something like that. If you actually wanted to research a company, you would have to have the company actually mail you documents and things like this, right? So the whole investment process from the retail side was near impossible. And so if you're thinking about who were even like individual stock pickers or something back then, it was really only the highest net worth individuals out there were doing things like that because it was just out of the reach of so many other folks, right? So most folks just kind of looked at it and they're like, nah, how am I going to individually stock pick and do research and things like that? Imagine it's 1977, right? And one of your stocks falls 8%. And you're like, what? Why is my stock down 8%? And you're trying to get the news and you don't get it and find out the information until like 4 days later, right? In terms of what actually happened there. Or you have to wait for the newspaper to come out the next day and hope that it covers it. And then it doesn't. And you're like, what the crap? How am I going to figure out why my stock was down 8% yesterday? It was a different time period, right? And it was, let's just call it a very difficult time period to be a retail investor, and it was pretty much non-existent unless you were very high net worth, right? And then all changed in the 1990s. The internet changed everything forever for the retail investor. Suddenly, think about this, suddenly, almost overnight, now if you wanted any company's information, you could pull up a company's information in a matter of maybe seconds, maybe a lot of seconds. That AOL was slow back in the day, and then somebody pick up the phone and then it ruin your whole internet connection. Oh man, some of you youngins might not know about that good old days, okay? But that was rough, okay? The dial-up days of AOL, oh my gosh, okay? But at the end of the day, that was transformative. That was insane, right? If you wanted to start placing trades, you could do it right through the internet. You didn't have to get on the phone and call somebody now. You could just do it right there, right? And also, with personal computers in general, it's made it much easier for you to track your portfolio, how much you have invested different places. Like everything got exponentially easier, and this made a lot more retail investors start to at least pay attention and start to care about the stock market. And what you had is a very, I would call it healthy kind of like new retail investor groups start to enter the market as the 90s kind of went throughout, right? Until it got very, very unhealthy at the very end of the 90s. It was a very healthy kind of influx of retail investors up until about 1999. And then 1999, 2000, that was the end, okay? And that was like such an the unhealthy amount of folks were getting in the market at that point in time, and you went into a full-scale bubble mode. But this thing right here, this changed everything forever for the retail investor and actually made it a realistic possibility that you could even do this thing, right? But if you look back at that time period, it was healthy. There was more and more retail folks getting in the market. Folks were doing good. They were making money. It wasn't crazy. But then as soon as 1999 hit, pretty much, it was game over. And, 99 through 2000, it just went absolutely ballistic, straight up to the moon as far as the markets and in terms of how many people were getting in the market. So unhealthy. And eventually it just formed a massive bubble that took quite a while to end up popping, okay, and coming back down to reality. Now, 2002 through 2007 was a bit of a lost time for, that's the image I pulled up there, man, the good old 2000 phones. Who remembers those? I was thinking about pulling up the Motorola Sidekick. You guys remember the Sidekick? Oh, man, okay. But there was kind of almost like a lost time in the stock market. It really was. And what actually had the hype and excitement, it wasn't the stock market, because a lot of people watched what either they got destroyed in the tech bubble or they watched other people get destroyed in the tech bubble. So a lot of people said, stock market, that ain't it. I'm not messing with that thing. Real estate, oh my gosh, real estate always goes up. This is beautiful. And so what actually got the hype and excitement from about 2002 through 2007 was real estate. And everybody wanted to own a second, third, fourth, fifth, 10th home if they could, right? And leverage, because, oh my gosh, that's the way to do it, right? And real estate had all the hype. It had all the excitement. It attracted the highest level of risk takers you could find out there, right? And these folks were the ones that leveraged the most. And those were the folks that went from owning, 8, 10, 15 properties to almost overnight owning 0 properties. It was like in a snap of fingers, right? It happened really darn quickly. And real estate doesn't usually move quick. Usually it's kind of like a slow get rich or slow like death, essentially in real estate. That was not that time period, right? Things happened very dramatically for folks. And in that whole time period, real estate was seen as the holy grail because you could make so much money on leveraged money in a fairly quick amount of time because real estate prices were going up so rapidly, right? And people looked at it as low to no risk. So they're like, this is the greatest thing ever. You can leverage, you can make huge returns, and simultaneously, we're taking low risk because it's real estate. It's not something. It's not like the stock market. It's not stocks. That's like speculative, crazy stuff. Look what happened in the tech bubble. Remember how many people got hurt in that, right? And so it was a whole time frame, right? And it created a real estate crisis in the United States of America, where we got way overbuilt, obviously, in the United States of America, and then we went through like 4 or 5 years of like hardly any construction for real estate compared to what it was previously, right? Which is actually a similar phenomenon that's about to happen nonetheless now. It's just not quite as dramatic. It's funny, everything that's happened recently, it reminds me so much of these past time periods, whether it be the stock market in regards to the tech bubble, or whether it be what's going on in the real estate industry, and that's going to be a similar phenomenon, the great financial crisis. It's just to a lesser extent nonetheless, okay? So that was that time period. Then you had the great financial crisis happen, right? And the stock market started to fall in 2007, and it bottomed out in early 2009. And all the indexes fell over 50%. Now, this changed a lot for a lot of folks because in the tech bubble, a lot of people looked at that and they're like, well, it's just like, this was a false assumption because the indexes also fell huge in the tech bubble. But people looked at that and they're like, well, it was just, some speculative stocks, tech stocks, things like that. And so if you are in other things, you're going to be just fine, right? And so people believed that like index funds and all those things would be fine, right? Until they fell over 50% and they all got cut in half. And that led people to be very negative on the stock market in general now. It went from like, oh, it's just so speculative stocks to it's everything. And so a lot of people got very, very jaded in that time. And as somebody that entered the stock market at the end of 2008 and into 2009, I can tell you, no one had positive things to say about the stock market. Everybody only had negative things to say, or they were indifferent about it. There was no one that was like, oh yeah, great decision, Jeremy, yeah, get into that stock market. No, okay. No one was positive on that. Why? Because everybody just got obliterated. You got obliterated in the tech bubble. 7 years, 8 years later, then it's obliteration in the indexes. So it's like, oh my gosh, okay? And so a lot of people just started looking at the market in general when it comes to the stock market as a very jaded perspective of the market, stocks, all those sorts of things, right? So coming out of the, great financial crisis situation, for at least the next several years, you couldn't get people, retail folks, to be even interested in the market. No one was interested, right? You had a few stragglers like me that were getting in and were like, optimistic and things like that. But I'm telling you, it was tough sledding. Retail wanted really nothing to do with the market. Oh, hell no, man. I don't want anything to do with those stocks. Look what happened to all the indexes. Why would I risk my money in that? So even if people had money to invest in the market, what a lot of folks did is they just sat on cash, essentially. That's all they did. And they missed some tremendous opportunities in stocks, in the indexes, in real estate as well, because a lot of people were scared. They were frightened, and they had been hurt badly. Let's just call it that. And when you're hurt badly, it doesn't matter what you're hurt badly in life, right? You go into the next situation very, very scared, right? Imagine maybe you've had your heart broken before, okay? A boyfriend or girlfriend broke your heart, whatever, right? And what are you going to treat the next relationship? You're going to go in very skeptical, right? It's going to be hard to win you over because you've been hurt very bad and you're carrying this baggage behind you, right? They call it baggage when it comes to relationships, right? The same exact thing happens in the financial markets. You get heartbroken, you get hurt very bad. You are now carrying around a lot of baggage that you have to deal with, right? And through that baggage, a lot of folks can't get over it, and it prevents them from seeing the next opportunity. No different than in a relationship. If you get your heart broken, you're not as likely to fall in love again or find that perfect person, even though they might be right in front of your face, they might be out there. You never find that person because you're not even open to that opportunity. And coming out of the great financial crisis, a lot of people were like that for many, many years. Even if the opportunity was right here and it's like, do you not see this right in front of you? A lot of people are like, they weren't even open to it. And that's unfortunate, but it was what happened, okay? And so we had that time period that essentially happened where people were like, oh, hell no, I don't want anything to do with stocks, the market, don't talk to me about that, okay? Then in 2013, things started to slowly change. So what began to happen was the economy started getting much stronger, unemployment continued to drop. Coming out of the great financial crisis, unemployment stayed very high for a very long time, and the economy stayed actually very weak. As the economy ticked up and got better and better in 2013 into 2014, a lot more retail folks started to trickle into the market, right? Plus now it was, we were many, many years removed from the great financial crisis. So people could start to move on. They could start to open their heart once again and their mind, right? And be at least welcoming. And so from about 2013 through 2020, right? And when I say 2020, I'm basically meaning prior to Rona, you had a very healthy trickle into the market, right? Very healthy trickle in where just kind of like never like a blow off top scenario, never like everybody's getting in the market, just like slowly but surely over time, more and more folks got interested in the market, right? And they're like, oh, this is a good opportunity. I'm going to learn how to pick stocks. I'm going to build a portfolio of 5, 10, 15, 20 stocks, right? And kind of do it that way, right? And some folks even got into index funds, and some people did a combo where they were doing some money in index funds, some money in individual stocks, and just building out their portfolio. And it was very, very healthy. For that was a 7-year period that was extremely healthy, one of the healthiest markets I've seen during those years, okay? And then what happened was Rona changed everything. You suddenly had all the stimulus money out there. You had everybody paying attention to the financial markets. A lot of people were also at home, and you had a very unhealthy dynamic happen right after Rona. And essentially, between the Fed and people's perspectives, we ended up building into like a tech bubble 2.0, right? And this was very unhealthy because all of a sudden everybody wanted to get in the market, right? Everybody wanted to get in the market. And, as somebody on YouTube, I saw this. Like, I see all these retail folks come in, right? And people that never would have been interested in the market were only interested because the market was going up so dang much so fast, right? And they're probably hearing from their friends and family, oh, did you see, they're making so much, right? You had folks that were the YouTubers that went all of a sudden starting to talk about all these different stock market subjects, right? And all of a sudden they're just like covering stock market. You had new ones coming out of nowhere that all of a sudden were getting like 100,000 views a video. It was an insane time period, right? And you had the meme stock movement, the AMC, the GameStop. You had so many like things that you even forgotten about during that time period, right? That were just like Insanity. And obviously, with the most famous retail stock was doing so good during that time, which was Tesla stock, that's the most famous retail stock, right? It led a lot of folks to just this euphoric feeling, and everybody wanted in on a piece of the pie, right? Because look at how much money is being made out there. And whenever there's a lot of money being made somewhere, what we know, humans are going to go to that place. That's the bottom line. It's always been like that. And when it's real estate, everybody wants to get into real estate. When it's stocks, everybody wants to get into stocks. When it's crypto, all of a sudden everybody wants to get into crypto, right? I can guarantee you, if Bitcoin tomorrow went from, I don't know where it's at today, maybe 17,000. If Bitcoin, not tomorrow, let's say over this next year, Bitcoin goes from 17,000 to 170,000. Do you know how many people are going to be investing in Bitcoin? Do you know how many people are going to be talking about it? That's what happens whenever there's money out there, and especially if it's easy money, just buy something and it goes up, right? People are going to flock there, okay? And it becomes a lot of fun. Why do you think casinos are so busy? Why are casinos so busy all the time? I live in Las Vegas. You ever go down the strip? Places are packed. It's always packed, right? You ever, nowadays, like casinos are everywhere in the United States of America. Why are they so busy? People love it. They love the potential of easy money. That's the bottom line, right? And so even folks that didn't want to do research, wanted nothing to do with studying business models or listening to conference calls or reading investment reports, those folks got in the market because it's easy money. And so we had this ridiculous, so unhealthy blow off top, man. Remember the Dave Portnoy's and all those folks, man, just getting in the market, and everybody's going to be the next Warren Buffett, right? Remember when Dave Portnoy was saying that he's better than Buffett, or Buffett's a joke, or whatever he was saying, right? That was the vibe. That was the market. It's the most unhealthy market we've had, other than the tech bubble. That was the tech bubble was the most unhealthy. This is the number 2 most unhealthy market we've been into, honestly, other than maybe the Great Depression. Extremely, extremely unhealthy. But that's what happened, and that's what played out, right? Now, going into 2023, we have, I think here's kind of the belief out there. One is like, screw the stock market, right? Because people have been sliced and diced in the market really bad. And so they don't even want to invest in anything in relation to the stock market. You got another group of folks that are saying, screw individual stocks, I'm only going to index funds moving forward, right? And that's a group of folks. You have some folks that are saying, I'll buy after the recession's over, right? Because there's a big belief that we're going to have some sort of recession in 2023. It's just a question of how deep is it going to be. And they're saying, after that's over, I'll buy. Then you got people saying, I'll buy after Biden's out of office, right? Then you got other people saying, I'll buy after the Fed pivots, right? Now, all these are unhealthy decisions, every single one of them. There's not one that's unhealthy. It doesn't mean they're wrong, but they're not healthy. If you're basing your investment decisions only based upon what the Fed does, or a president does, or if there's a recession or not, or you're just saying screw the market in general, none of those are healthy. Let's be very clear about that. You could be right, but it's unhealthy. And so just understand, it's no different than, this is no different than treating the market as like that speculative thing that you could make so much money in, right? Both are wrong. It's just, it's like, oh, maybe you can get lucky here or there, but they're all wrong. None of those are correct. They're all wrong. And then you got folks saying, that are in the buy the dip crowd, that are just very low confidence, that are second and third guessing everything because of what's happened over the past, let's call it year or two, right? And so we're at a very, very low moment for the market in general. Now, I give a message to the private stock group, and I want to actually read you guys this message because I think it's very important, okay? I said, a little thoughts for me as we get closer to 2023. Don't count yourself out. The retail investor community is in a state of disbelief, extremely low confidence, and giving up. This couldn't be further from the feeling going into 2021, which was a feeling of euphoria. We can conquer the world. Everyone can be a successful, good investor. The truth is, neither of those feelings are reality. Both were heavily influenced by the Fed either trying to destroy the market, which is what they've been doing for the past year, or massive artificially inflate the market, which is obviously what they were doing basically from April 2020 all the way through 2021. Massive artificial inflation, inflate of the market, right? We have to focus on what we can control. We cannot control what the Fed does, what happens to the economy moving forward. We can control in 2023 and moving forward our research, listen to conference calls, reading 10Ks, staying disciplined with our decision making, staying away from unprofitable companies or only investing small amounts, staying diversified in our portfolios, paying fair price for revenue and net income growth companies with good balance sheets, etc. As for me, have I lost confidence after my horrible year? Absolutely not. I know exactly what I need to do moving forward. Stick with the blueprint and put in the work. Investors are not judged based upon 1 year performance. They're judged on 5, 10, 20-year performance, which is 100% true. I mean, if you were to go into an investment bank and try to get a job or something like that, and they ask, you think they're going to ask your 1 year performance? Who cares about 1 year performance? If it's positive or negative, no one cares. Because it's no different than like poker, right? The best poker player in the world could play with a bunch of amateurs, and even the best poker player could lose on that given night, right? Over the long term, they'll take all the bad poker players' money, but in one night or 1 week or even 1 month, they could actually lose to those bad players. That's what happens, right? And the same thing can happen in the market, where you can underperform the market, you can do very bad or good. It doesn't mean you're a great investor, you're the worst investor. It's just not the way it works. Everybody's always judged. Like the reason Warren Buffett's so respected, or Peter Lynch is so respected, is because those guys had great performance over a long period of time. It wasn't like they just had 1 year. Like no one remembers anybody that just has one great year. You have to put a string of like great years together for a long time and make it through the bad markets as well. I'm doing everything in my power for the coming years to make everyone proud. This is not my first time getting away from the blueprint, but hopefully it's my last. There's no such thing as a great story without adversity. A flower does not think about competing with the flower next to it, it just blooms. You will face many defeats in life, but don't let yourself be defeated in the end, okay? This is the stock market since 1989, which is the year I was born, okay? And what you're going to find over time, and there's been so much that's happened since I was born, right, in 1989. There's so much. And so many market crashes, so many market corrections, so many bad things that happen in the world since 1989, right? And good things as well, right? But ultimately, what do we find? Everything ends up just being a blip on the radar. Even the tech bubble, which is crazy to think about, even that became a blip on the radar, right? Everything just becomes a little blip. And so I know it's sometimes hard to fathom, but if you look out over the next 20 to 30 years, you got to understand, if you buy the NASDAQ today, if you buy the S&P 500 today, if you buy countless stocks today, you're stealing money. And I know it's very hard to understand because you see the high numbers of like, oh, the NASDAQ's at 10,000, 11,000, whatever, right? The S&P 500's at 4,000, 3,900, whatever, right? But you've got to understand, over the next 20, 30 years, the S&P 500's going to 10,000 plus, right? And the NASDAQ's going to 30,000 plus, if not 50,000 plus. And all these dips, and even this one we're in right now, which could continue into 2023, depending upon how the economy gets, right? And how earnings do. Even this one, we will look back on in 10, 20, 30 years and be like, wow, that was just a blip on the radar. It was just one of these, right? Look at even the great financial crisis. Think about this for a moment. The indexes fell over 50%, over 50%. And that's just a blip on the radar. So imagine what this is going to be. It's just going to be another blip on the radar over time. And that's the way the market works, right? Warren Buffett a few years ago, I think it was back in 2017, he said something that got him a little publicity, which he certainly doesn't need any more publicity, right? Man's got such a successful track record over time and has done amazing for himself, right? But he basically said the Dow's going to 1 million over the next 100 years. 1 million. The Dow today's, 30,000 something, right? Maybe 30, I don't know, maybe, what is the Dow? 31,000, 32,000, something like that. And he says it's going to 1 million over the next 100 years. And he'll probably be right on that, to be quite honest, right? And sometimes it's hard to fathom those sorts of numbers when you're in the time period you're in right now. But we just have to remember what's going to happen here and what's going to play out. And, betting against the global economy, betting against the United States economy, you always come up short every single time. You always come up short. And I think it's just very, very important to remember that these time periods you go through are time periods that you have to take advantage of buying assets for cheap. 2023 is going to be a year you have to take advantage of buying assets for cheap because they don't stay cheap forever. You get, sometimes it depends on how bad the market is. Sometimes you get only maybe a few weeks or a few months of a correction to buy stocks. Sometimes if you're lucky, you can get a 1 to 3 year period where stocks just go down. You saw this in the tech bubble, right? You saw this in the great financial crisis, where stocks are just in a deflated manner for 1 to 3 years, and you get to buy those assets at very cheap prices. And we're going through one of those time periods right now, right? Where the market's already been downtrending for over a year now. And, if 2023, the economy gets far worse and earnings get far worse, we'll have some more downtrending to go here, right? And you have to take advantage of those opportunities because in the end, you'll look back and be like, gosh, man, remember that? We thought that was so crazy and so dramatic. And actually, it was just another thing and great buying opportunity in the market, right? It's what happens. So we just have to remember that as retail investors in the market, okay? So keep the faith, keep the confidence, and build back stronger. Stick to the blueprint and, build out a great portfolio that you're going to be very proud of. And, 10, 15, 20 stocks. If you want to add, obviously, index funds, that's your own choice. Me, personally, I don't do it. That's not my choice. I've never tried to be average at anything in life. Average gets you average results. That's the bottom line. And there's no hate toward that. It's just, that's not me. That's not my style. If you told me I only could buy index funds the rest of my life, I wouldn't even be in the stock market. I'd be in real estate or something else. Like, that's just me. I've never been that type of person. I don't get average results ever. I'll always rise to the top in any situation. It doesn't matter. And that's just me. And other people are like me as well. And so they enjoy this game, right? And everything that comes with it, which is the downs, which is sometimes getting over to sides that you shouldn't be on, right? And making mistakes. And you have to admit those. You have to come and say, I made a mistake here, and I'm going to get back on the right track and move forward. So that's that. Much love as always, guys. Appreciate you, and have a great day.